Barizeni. May 2015, question 2. Part B of the question, doing question 2. And we are told that the following statement of financial position related to H Limited, its subsidiary S Limited, and subsidiary W Limited. So that means we have a horizontal group structure. We have H Limited, its subsidiary S Limited, and subsidiary W Limited. So that's a vertical structure. As at that 1st of March 2015. So you're given the statement of financial position. Additional information number 1. H Limited acquired 30 million ordinary shares in S on 1st of April 2008, when the balance of the retained profits of S Limited was 800 million and the revaluation reserve was 260. So H acquired S 30 million of its ordinary share. Now let's go to the balance sheet. S. How many ordinary shares does S have? Yeah, we have 50 shares. So 3/5, that is 60%. So that means the non-controlling interest element will be 40%. Number 2, I told that S Limited acquired 30 million shares in W Limited. S acquired W 30 million of its shares. So now let's go to the balance sheet. How many shares does W Limited has? We also have 50. 3/5, that is 60%. So H is a parent company and S is a subsidiary of which we are controlling 60. Therefore, the non-controlling interest is 40. S acquired W, which is a subsidiary because they are controlling 60%. So that means if S can control W, also the parent can control W. And how much is the control of HW? So it's 60% of 60%. Can you get that in? 6%. So therefore, the non-controlling interest will be, is that 64? Yeah, who is W? W is a subsidiary. So if you just make a small mistake, that means 20 marks, you are out. W Limited is a what? It's a subsidiary. Good. It's a subsidiary. I remember when I was introducing this, there is something I tried to explain. It seems you are not that keen. I say that if the subsidiary, if S can control W, that also means the subsequent parent can also control. It's only that its direct control is 36%. Actually, can you read the question again? The following statement of financial position related to H Limited, its subsidiary S Limited, and subsidiary W Limited. So if a subsidiary can be able to control a subsidiary, also means the parent can also control that subsidiary, even if the proportion is not more than 50%. But if H was controlling S, let's assume even 100%, is a wholly owned subsidiary, then S acquired W 50%. Now, who is W to S, not to H? Who is W to S? It's a? I never said it's a joint venture. We said that a joint venture, it's only when you are told that there is a joint control. Are you together? So therefore, W is a It's an associate. So that means S cannot control W. Therefore, even H cannot control W. Are you together? But if S, for example, this was 51, that was 51%. That means S can control W. Automatically, even the parent can be able to control the W. Good. So that's all. So here, number 2, we are told that S Limited acquired 30 million shares in W Limited on 30th of September 2014. Now, when are we report? When is the reporting date? When is the reporting date? 31st of March. And we acquired S acquired W on 30th of September 2014. How many months end of the year? It's how many months? Yeah, so that means W has been a subsidiary to S for only 6 months. 6 months. But S was acquired in 2008. So those are many years ago. Good. So that means W has been a subsidiary to S for only 6 months of the year. Then you are told that on that date, the fair value of some items of plant was 60 million in excess of the book value. What is that? That's a revaluation. Revaluation in W Limited. You are told that on that date, the fair value of some item of plant was 60 million in excess of the book value. So there was a revaluation gain of 60. Then, in addition, H Limited had some patent which had a fair value of 10 million, but were not shown in the book. So there was also an unrecognized patent which had a value of 10 million. The group charges depreciation of 10% per annum on the proportionate basis on plant and amortization of 20% per annum on intangible assets. So we have the depreciation of the revalued assets. So it's 16. I told that the depreciation rate is 10%, of which you get 6. But W have been a subsidiary for only 6 months, 6 over 12, and you get an amount of 3. So also we provide the amortization. There was unrecognized patent of 10, and they are told that they amortize at the rate of 20% per annum. So 20%, that is 2, then has been subsidiary for only 6 months. So we recognize an amortization of 1. Number 3. Between 30th September 2014 and 31st of March 2015, now that's the post-acquisition period, W Limited sales to H and S amounted to 40 million and 160 million. So there was intergroup sales. And who is the seller? We are told that it's W who sold to S, also W sold to H. And we are told that between 30th of September 2014 and 31st of March 2015, W Limited sales to H. It's W to H. Eh? So W to H and S, also W to S, amounted to 40 million and 160 million respectively. Remember, I said that intergroup sales should be admitted in full from both sales and the cost of sale. That would be an amount of, is it 400? Yes. Then you also need to recognize the amount of the unrealized profit on the closing stock. Then you're told that respectively reporting a profit of 25% on selling price. So that's margin. So it's just 25%, 25% of 240. Here it's of 160. Then you are told that half of the good was still in the closing inventory as at that 1st of March 2015. Half of the goods. 240, 60 divided by 2 is 30. 80, 40, is it 20? So you have a total of how much? 50. So for unrealized profit, you added to the cost of sales, you made from the closing stock. Good. Number 4, H Limited and S Limited owed W. What is that? That's the intergroup balances. And we say that for the intergroup balances, they are eliminated from both account receivable and account payable. So you told that H Limited and S Limited owed W Limited 36 and that 2. So 36 plus that 2, that's an amount of 68. So you eliminate from both account receivable and account payable. Good. Number 5. The profit after tax of W Limited for the year ended that 1st of March 2015 amounted to 40 million. And it's assumed that to accrue evenly throughout the year, no dividend were paid by W Limited during the year. So we acquired W. When did we acquire W? 6 months to end of the, and you are told that during the year they made a profit of how much? 240. So that means how much was the pre-acquisition profit for the year? 120. How much is the post? It's just 240 you divide by 2. Is it 120, 120? Good. Number 6. The goodwill of H and S Limited is fully impaired. Yeah, the goodwill of H Limited in S Limited is fully impaired, while that of S in W Limited is considered to be 10% impaired. The group uses partial goodwill method of accounting for goodwill. So now let's compute goodwill on acquisition. Should we combine or just compute them separately? So we start with acquisition of S Limited. We just combine the two. S Limited, also in acquisition of W Limited. And they say that together good will take the amount of purchase consideration. Now let's go to the non-current assets. And non-current assets, we have the investments. How much was investment in S Limited? It's 840. Investment in W? Yeah, it's 750. But remember, W was acquired by S, of which H controlled S 60%. So this 750, the parent contributed 60%. So how much was the purchase consideration? Sorry? 450. Then you deduct net assets acquired. For the net asset acquired, let's go to the equity. What do we have in our equity? Number 1, we have the ordinary share capital. Also, we have retained profit. But for retained profit, you say that you take the pre-acquisition retained earnings as well as pre-acquisition reserves. That's the valuation reserve. Now, ordinary share capital for S was an amount of 500. What about W? Yeah, it's also 500. Then pre-acquisition retained earnings. Now let's go to note number 1. Note number 1. H Limited acquired 30 million ordinary share in S Limited on 1st of April 2008, when the balance of the retained profit was 800, and the valuation reserve was 260. Let's go to W. In W, how much is the retained earnings? There it is. It's in the balance sheet. There it is in the balance sheet. How much is it? Yeah, it's 680. Now let's be here. We want to compute the pre-acquisition retained earnings in W. And remember, we acquired W 6 months to the end of the year. And I told that during the year, they made a profit of how much? 240. So that means it's 120. 120. So we are given the retained earnings at the reporting date, which is 680. So can we be able to get the retained at the date of acquisition? So that takes 680 minus 120 to get 56, right? It's 680 you minus the post-acquisition retained earnings. So that means at the date of acquisition, I've just taken the 680 you minus the post-acquisition retained earnings. So that means at the date of acquisition, it was an amount of 560. Then there was pre-acquisition reserves. Do we have any revaluation? Let's go back to the trial balance. Do we have that? I mean in your balance sheet. Can you see the revaluation reserves? How much? How much can you see? 0. Good. Then At the date of acquisition, there was revaluation in W. There was an item of plant which had a fair value of 60 million above the carrying amount. Also, there was a patent that they never recognized. So that means 60 plus 10, that means our net asset was understated by 70. So you take the 60 for plant, and then there was unrecognized patent, 10. So that means there was a revaluation reserve of how much? 70, good. 13, 14, 15. This is 15, 60. You multiply by? So 60% of 15, 60 is how much? 936. This is it 1130? 1130. Then you multiply by? You multiply by 36. Good. The parent is controlling 36. 406. Let's work with 407. So how much will be the goodwill? Sorry? 43.2. Just 43. What about this? This one is a capital reserve. Again, a negative of how much? 90? Yeah, that's what we call a capital reserve. And they decided to write it off. Then you can deduct the impairment loss. So now let's go to note number, the last note. The goodwill of H Limited and S in S Limited was fully? Yeah, there was a capital reserve and negative goodwill. They decided to write it off. While that of S in W Limited is considered to be 10% impaired. So 10% of this is how much? 4.3. So how much will be the net goodwill? Now to be taken to the balance sheet. An amount of that? Yeah, 38.7. Good. Required. The group statement of financial position as at that 1st of March 2015. So the parent is H, so therefore it will be H group. Consolidated statement of financial position at 31st of March 2015. Then our shillings are in millions. Start with the assets. The assets, we have the non-current assets. And the non-current assets, we have PP. Yeah, so we have a subsidiary relationship. So that means you consolidate H, S, and W, all of them. The groups, I told you by the way, once you have a question on group, first of all, identify the group structure so that you can determine who will you consolidate. Then the next thing, determine whether there was any subsidiary acquired during the accounting period for the apportionment. But the good thing with this question, we are not preparing the income statement. Because if you are to prepare the income statement, the income and expenses are assumed to be accrued evenly. We could have taken for W for only the 6 months. So, but to the balance sheet, we don't apportion. So PP, we have 1280. Then you add 920, and then for which was an amount of 700. Then you add 60, and then you minus what? You minus 3. There was an item that was revalued upward by 60, and later you provided a precision of how much? 3. So how much will be the PP? Sorry? 29.27. 57. Then investment in S, investment in W will be replaced by what? Goodwill. And we have the net goodwill only in W, an amount of 38.7. Then there was unrecorded patent. So we recognize the patent. The value was 10, but during the year there was an amortization of how much? 1. So 9. Current assets. And at the current assets, we have inventories. We also have trade receivables. And then we have bank balance. So for the inventories, we have for 20. You add an amount of for 10. and then you add an amount of 210. Then you eliminate the unrealized profit. How much was the unrealized profit? 50. Then we have account receivable. Account receivable, you take 680. Then you add 540. And then you add 390. Then you eliminate the intergroup balances, an amount of 68. Then we have the bank balance. You just take 80 plus 90. And then you add 100. This was 270. This one is? This one, 1542. 990. 990. So now give me the total assets. Get an amount of? Then we have equity and liabilities. At least there we have a free mark for ordinary share capital. How much is the ordinary share capital? Yeah, we see that for ordinary share capital, you only take for the parent. Then we also have, you see the revaluation we have is 260, and it's only for who? For S, right? Yes, remember you see that for reserves, you take the parent, then you add the investee share of post-acquisition. Now for what we have 260, of which it was the same as pre-acquisition. In short, there was no post-acquisition changes, so there is no revaluation. Then we have retained earnings, then we have NC. Yeah, we said, what do we say about them? Yeah, we see that you compute at your own risk, right? Now let's go to the non-current liability. Under the current liabilities, we have trade payable. That's a free mark. Also, you have the current tax. Trade payable, you take 390. You take 380. You add 210. Then you minus the intergroup balances of 68. Current tax, you take 40. You add 20, and then you add 10. That is 70. This one is 9. Can take a screenshot, but we don't have to take a screenshot. So you have to prove that you're in school today. We can try another question. September 2021. Question 1. On 1st of October 2019, H Limited acquired 80% of ordinary share in S Limited when the retained earnings of S Limited were 53.35 million. So H acquired S and acquired 80%. So that means an uncontrolling interest is how much? Yeah, then CI is 20%. And you acquired them on 1st of October 2019. On that date, H Limited, on the same date, H Limited acquired 40% of the ordinary shares in H. So that's a horizontal structure. The parent is H. H acquired S, also acquired A. 40%, 80%. So the non-controlling interest in S is an amount of, yeah, because S is a subsidiary, it's a, yeah, it's an associate. So therefore, you cannot control, you can only exercise and have a significant influence. So now let's read the first paragraph again. On 1st of October 2019, H Limited acquired 80% of the ordinary share in S Limited when the retained earnings in S Limited were 53.35 million. On the same date, H Limited acquired 40% of the ordinary share in A Limited, paying 16 shillings per share. Now that's the purchase consideration. How much was the purchase consideration? Purchase consideration can you go to the ordinary share capital? How many shares did A have? A is our associate. You have how many shares? Yeah, it's 300. Now let's be here. But of this 300, we paid how much per share? We acquired only 40%. First of all, you multiply by? So how many shares do we acquire? Is it 120? Then of the shares acquired, each was paid an amount of how much? So how much was the purchase consideration? Sorry? 1920. Good. So that's the purchase consideration of the cost of investment in the associate. Then you are told that the acquisition of the ordinary share in S Limited, the acquisition of S, that's our subsidiary, was through a share exchange of one ordinary share of H for every 2 shares in. Let's be here. Acquisition of S Limited. Those are through share issue. H acquired S. Now it's H acquiring S. And then you are told that the acquisition of the ordinary share in S was through a share exchange of one ordinary share in H, one in H, for every 2 shares in S. For every 2 shares in S. Remember, you're the one acquiring S. So that means for every 2 shares we acquire, we pay you through issue of 1 of our share. Now let's go to the ordinary share capital. How many shares did S have? It's 500, right? It's 500, but of this 500, we only acquired 80%. Is it not 400? 400. So for every 2 shares, we issue 1 share. What about 400? It's an amount of 200 shares. So what we need is the purchase consideration. Then you are told that the market price of S and H Limited on that date of acquisition were 30 and 18. Now, whose share are those? Is it for H or S? We are computing X. X is for H, right? So now, give me how much was the market price per share of H? 30. So how much is that? 600 or 6,000? 6,000. So that's the purchase consideration. How much was an uncontrolling interest? Let's be here. Of the 500, we acquired 80. Are you together? So how much is the uncontrolling interest? Is 20% of 500, which is 100. And those are share in S. So at the date of acquisition, how much was the share price for S? 18. So that means at the date of acquisition, the fair value of the non-controlling interest was 1,800. Good. Number 3. I mean paragraph 3. In addition, H Limited agreed to pay a further amount of 25 of shillings 25 per acquired share in S on 1st of October 20. That's after how many years? Can you read that paragraph again? That's after 3? Is it 3 years or 2 years? Yes, that's why I say always engage your fingers. Eh? Your fingers will not lie. Those are how many years? After 2 years. Now let's be here. We are told that in addition, H agreed to pay a further amount of 25 per acquired share in S on 1st of October 2021. So these are shares we acquired. We acquired how many shares? We acquired 400 shares. Are you together? And then you have promised them after 2 years we'll add an amount of. So how much is the deferred payment? 10,000, right? Then you are told that H Limited cost of capital is 10% per annum, and 1 shilling receivable in 2 years' time has a present value of 83%. So that means the deferred payment now you'll take 10,000, then you multiply by the present value. See, they are discounting. You multiply by 0.8. The present value of each shilling is 83%. So how much is that? 8,300. Good. After all, we are doing this to compute the goodwill. So you say that you can ignore goodwill. Yes. The draft financial statement of the group companies are as follows. So we're given the income statement, then we have the statement of financial position. Additional information. Number 1. At the date of acquisition, the fair value of S Limited, S is our subsidiary, identifiable net asset, approximated their book value with exemption to an item of plant which had a fair value of 200 million above the carrying value. So what is that? Yeah, there was a revaluation gain. And this is what we call the pre-acquisition, because we determined the value at the date of acquisition, of which there was a fair value gain of how much? 200 above the carrying amount. The plant had a remaining useful life of 10 years, straightened depreciation at the date of acquisition. So we provide depreciation. It's 200, you divide by 10. So how much depreciation per annum? 20. But when did we acquire? When did we acquire S? Just look at the first paragraph. On 1st of? Okay, when is our reporting date? Just go to the required. How many months end of the year? There are 6 months. Engage your fingers. 5 or 6? 6. So that means both S and A has been a subsidiary for only 6 months? Yeah, 6 months. So that means for depreciation, 6/12, recognize an amount of 10. Then you're told that depreciation on plant is classified as part of cost of. Yeah, actually, this one usually do add to cost of sale, and then you eliminate it from the PPE. Good. Then you are told that the fair value of plant had not been reflected in S Limited financial statement. No fair value adjustments were required on acquisition of A Limited. In addition, at the same date of acquisition, S Limited had an internally generated brand, which the director of H Limited believed to have a fair value of 300. So that's what we call unrecorded asset. There was a brand of which had a value of how much? A fair value of 300 at the date of acquisition. The brand had an estimated useful life of 6 years. So we provide amortization. This is an intangible asset. So at the date of acquisition, the fair value was 300 to be amortized for the next 6 years. 300 divided by 6, is it 50? 50. Then you multiply by 6/12. and you get an amount of, then you are told that amortization is charged and classified as an admin expense. So added to admin expenses, then you deduct it from the brand. See, that's a depreciation, right? Depreciation reduces the value of the asset. Good. Number 2. Immediately after acquisition of S Limited, H Limited invested in 250 million of 8% loan in S Limited. Investment in loan. Who invested? Who invested? And invested in S. An amount of 200 and? Yeah, that in short, H gave a loan to S. What, how much? 250. Is it attracting interest? Yes. So immediately after acquisition of S, H invested in 250 million in an 8% loan note of S Limited. So how much will be the interest? It's 8% of 200 and? But there have been a subsidiary for only how many months? 6/12. So how much is that? 10. Now listen here. The parent invested. So if the parent invested, had recognized this amount of 250 as an asset, right? What about S? It is part of the loan. Are you together? Also, if the parent invested in 250 and this interest is earning an 8% interest, so that means the parent will recall this one is a financial instrument. Are you together? S, it's an asset. So therefore, it recognizes an interest income an amount of 10. What about S? To S is a liability. Therefore, they will pay an interest. So to them, we recognize as part of finance cost. Finance cost. So the parent will recognize an income of 10. The subsidiary recognize an expense, an interest expense, an amount of 10. But that's what we call an intergroup transaction. From the parent other income, you eliminate 10. Also from the subsidiary, from the finance cost, you eliminate an amount of 10. I repeat again. The 250, the parent will recognize an asset. So you eliminate it from investments, this 250. Then the subsidiary has recognized this one amount as a liability. So you eliminate it from the liability. Yeah, the intergroup balances. Number 3. After the acquisition of S, S sold goods. That's the intergroup sales. Good. And we are told that after the acquisition, S sold good to H. S sold to S. Now that's an upstream sales. The subsidiary selling to the parent. After the acquisition, S sold goods to H for 500 million. So how do we treat this 500? We say that intergroup sales will be emitted in full from both sales and cost of. Then we need to provide the element of unrealized profit on the closing stock. After the acquisition, S sold goods to H for 500 million. S Limited had marked up this good at 25% above the cost. So it's 25/125. Then you are told that H Limited had 30% of this good in the inventory as of that 1st of March 2020. So it's 25/125, that's 20%. Of 500, that's 100. And then we retain 30%. So get an unrealized profit an amount of. And you see that for unrealized profit, you added to the cost of sales, you are made from the closing stock. Number 4. H Limited policy is to value the non-controlling interest in S at its fair value. Now, up to that point, what does it mean? When computing the goodwill, which method do we use? Sorry? Yes, we use the full goodwill. Yeah, we see that when NCI is measured at fair value, when computing the goodwill computed, if you look at your notes on the first page, you have indicated that in brackets. Can you look at your notes? If you have your notes on group, the first page. Is it there? Now let's proceed. H Limited policies to value the non-controlling interest in S at its fair value at the date of acquisition. For the purposes of the market price of, for this purpose, the market price of S Limited share on the date of acquisition is considered to be representative of the fair value. This is what we had already done. I computed the fair value, NCI fair value. Where was it? Yes, NCI. 20% of the 500, which is 100. Then we are told that the share price of S was to present the fair value. So I multiply by 18. So that's the NCI fair value at the date of acquisition. Number 5, impairment tests were carried out on that 1st of March 2020. Now that's at the end of the year, which concluded that due to poor trading performance, the investment in A Limited had been impaired to an extent of 80. That's impairment in A, that's in associate. S Limited paid dividend amounting to 400 before the year end. Number 7, all the income and expenses of the 3 companies were deemed to accrue evenly over the year unless otherwise specified. Number 8, other than the share exchange in the acquisition of ordinary share in S, there are no other issue of ordinary share by the group of companies. Now in this question, remember you see that ordinary share capital and share premium, they are free marks. In this case, they are not free marks. Why? On the date of acquisition, we issued some share. How many shares we issued? It's not there, it's here. We issued how many shares? 200. And the market value was how much? 30. So this one will take it to the. Hey, who issued the ordinary share? Who is H? The parent. So that's what I'm asking. Let's go back to the balance sheet. How much? We see that for the ordinary share capital and share premium, you only take for the parent, right? How much for the parent ordinary share capital? 8,000. Then you add how much? You add 6,000? Yeah, and that's very wrong. Let me take you back again. Ordinary share capital are recognized at par value with any balance taken to the share free. Can you go back to the ordinary share capital? How much is the par value? It's 10. So that means the parent issued 200 shares. And the par value is how much? 2,000 is what will go to the ordinary share capital. But at that date, the market price was how much? So there was a premium of how much? Yeah, 200 each at 20, which is 4,000. You added to the share premium. Good. I just want to give you some 3 minutes. Can you try to comprehend what you have done? Now let's proceed. So how do we compute goodwill? Now let's compute goodwill in S. That's our subsidiary. How do we get the goodwill? We take the purchase consideration. How much was the purchase consideration? It's here. It's 200 each at 30. Now, it's a position of the subsidiary S. Are you together? A is an associate. For us, we don't consolidate. We account for it using the equity method. So S, acquisition of S, this was the amount paid. That is the purchase consideration amount of 6,000. Then there was a deferred payment. After 2 years, they promised to pay 25 shilling for every share, and they acquired 80% of 500, which is 400. Where is it? Yeah, it's 400 here, each at 20. So they expect a payment of how much? 10,000. But they were discounting. Actually, it's here. Yeah, the present value for every shillings is how much? 83%. So it was an amount of 80. Then you add, we're using the full goodwill method. So NCI fair value. And NCI fair value was an amount of 18. Then you raise the amount of net assets acquired. And for the net asset acquired, we go to the equity, we have the ordinary share capital. And we also had the share premium. Then you take the pre-acquisition retained earnings as well as pre-acquisition revaluation. How much was the ordinary share capital in S? It was 5,000. Then the share premium was an amount of 25. Then you take the pre-acquisition retained earnings, note number 1. Actually, here it is. Are we given? No. Why is it? Yes, you're given the first paragraph. You're told that on 1st October 2019, H acquired 80% of the ordinary shares in S Limited when the retained earnings of S Limited were 53.35. Then there was pre-acquisition revaluation. Now let's be here. There was revaluation gain, an amount of plant of 200, and then there was unrecognized or internally generated brand, and the brand at a fair value of how much? 300. So there was a total revaluation gain of how much? 5. So give me the total. Is it 13,335? So give me the goodwill. Here we're using the full goodwill method. So therefore, you will not take 80%. You take 100%. We're using the full goodwill method. So how much will be the goodwill? 27? Yeah. 2765. What about the investment in A using the equity method? How do we recognize investment in associate? Investment in associate, we say that we account for it using the equity method. We say that you take the purchase consideration, you raise or you add what? What are you adding? Yeah, post acquisition changes in net assets, and you see that for the net asset, mostly what changes the retained earnings. Then you deduct what? Impairment loss. And how much was the purchase consideration in associate? It's here. The purchase consideration for it was an amount of 19.20. Then you take the post-acquisition changes in net assets. So we are controlling a 40% of the post-acquisition. They have been a subsidiary for only 6 months. Let's go to the income statement. How much was the profit after tax for the year? Is it 600? Yes, an amount of 600 times 6 over 12. But this 600 was a loss, right? So therefore, instead of adding, we do what? we raise. So how much is that? 40% of 600 to 40, is it 120? Now in this case, you deduct, yeah, because they had recorded a loss. Then you raise impairment loss. You already given the impairment loss. Was it 80? Eh? Yes, I can see there's someone looking at me. So he expects me to say which note? It's note number 5. Go to note number 5. Impairment tests were carried out on that 1st of March 2020, which concluded that due to poor trading performance, the investment in A had been impaired to an extent of 80. You get an amount of 17? 20. Required consolidated statement of profit or loss for the year ended that 1st of March 2020. And then number B is the consolidated statement of financial position. So let's start with the income statement. So it's H group. Consolidated income statement for the year ended 31st of March 2020. Our shillings are in millions. Start with revenue. Then you raise the cost of sales and we get our gross profit. Revenue, you have 25,200. Then you add 18,000. But 18,000 you only take for 6 months? 6/12. Then for the cost of sale, you take 15,120. Then you take 12,000 times 6/12. Then you add, number 1, there was unrealized profit. Unrealized profit was an amount of 30. Then you add, there was depreciation. You are told that you take it to the cost of sale, an amount of 10. Then you eliminate in full the intergroup sale. For the intergroup sales, S sold to H an amount of how much? Amount was 500. So 25 plus 9, you get 34,200. 34,200, you get an amount of, is it 33,700? 15,120, you add 6,000, you add 40, you minus 500. You get? $26? 660? Okay, give me the gross profit. 14? 13,040. Then we have distribution cost. Now it has the expenses. We have distribution cost. Then we have admin expenses. Then we have finance cost. Then before the finance cost, you are given investment income. That's the interest and dividends. Yeah. So do we consolidate that? You see, it's only for the parent. That means those are the dividends that the parent received from S and A, plus there was an amount of interest which is received from investment in loan. Why is it? Here, yeah, an amount of this thing. So you don't consolidate that. So it's an intergroup transaction. So distribution cost, you add an amount of 1344. You add an amount of 420. It's just half of it, right? Admin expenses, you take 2196. You add an amount of, is it 540? Then you add, let's be here. The internally generated brand, there was an amortization. You're told that you take it to the admin expense, an amount of 25. Finance cost is 220. 150 divided by 2 gets 75. So how much is this? So this is 1764. What about that? 2761. So now give me the profit before tax. The impairment loss of 80, that was for the associate, and you accounted for it for the investment here. To the income statement, you only take the impairment for the subsidiary, of which there was no impairment. 8218. Then you raise tax expenses. Income tax expense, we had an amount of 1800. Then you had an amount of 600, and you get an amount of 24. Get the profit after tax. 58. Then we can add associate share of profit after tax. How much was that? So we'll take 40%. How much was the profit after tax? Negative 600. You multiply by 6 over 12. So how much is that? $120. So give me the total profit. 59. So we can take a screenshot. Actually, it should go down. 56? 56.90. So let's take a screenshot. Now let's present the statement of financial position. So we have the assets and current assets. So we have PPE. We have an amount of 25. We see that to the balance sheet, you don't apportion 16,300. Then there was a revaluation gain, an amount of 200. Then there was depreciation. Depreciation by how much? 10. So how much is that? $16,490. Then we have investment in A, 1920. Here it is. The purchase consideration in associate, we account for it using the equity method. So investment in associate. Now you recognize an amount of 1720. We had already computed that. Then there was goodwill with an amount of 2765. And then there was, which one? Sorry? It's how much? 41,490. Then we have the financial asset. How much is the financial asset? Or it's not there? Let's go to the current asset. So for the current assets, we have inventory. Also, you have trade receivables. And then we had cash and cash equivalents. So inventory takes 67. And then you add 6,000. Then you eliminate. Do we have any intergroup balances? I mean, unrealized profit, an amount of that. Receivables, we have 4150. You add 1,000. Do you have intergroup balances? How much was the intergroup balances? Also, here we had a brand. We had a brand, 300. Then there was an amortization, an amount of 25. You get 275. So there was no intergroup balances. So that's all. Cash and cash, we have 1980. Then an amount of 400. One will be 5150. This one will be 2380. This one will be 12,670, right? Good. Then we have equity and liabilities. Actually, there is something I forgot to deduct from the interest income. From the income statement you have prepared. From the finance cost, we are supposed to eliminate the 10. Yes. So you rectify that during the exams. So equity and liabilities, what do we have? We have ordinary share capital. How much is the amount? We see that you only take for the parent. An amount of 10,000, right? Then you also have share premium. How much is the share premium? Yeah, it's an amount of 8,000, right? Let me just write for you. It's 8,000. Then you add 2,000. Share premium, we had 4,000. Then we showed 400, another 4,000. Then we have retained earnings, and then you factor in the NCI. Then we have non-current liability. And non-current liability, we have 10% loan note. You take an amount of 76, then you add an amount of 2,000, then you minus 250. Yes, give me that. It can't be 73.50. 93.50. Then there was deferred payment. Yeah, we had a deferred payment, an amount of 83. Then we have the current liabilities. What do you have to the current liability? Yeah, we have the trade payables. Trade payable, we had 55. Then you add an amount of, and you get 10,700. Then we have the current tax. 28, you add 23, and you get 50. You can take a screenshot.